Hello everyone. In order to understand the basics of valuation, so far we took the example of a no growth company. Therefore, we could keep the cash flows in the different years constant, and that helped us in concentrating on the basics of different valuation methods available to value a company. Growth in cash flows adds to the complexity of valuation, and therefore we assumed it away while valuing the company previously. However, now we are looking at a growth company with a growth rate of 5%. Before dwelling further into the approaches, let's quickly look at the assumptions once again. The assumptions are that the net operating income is 100, the market value of debt is 100, the cost of debt is 10%, the tax rate is 20%, the cost of equity is 20%, and the growth rate is 5%. Now let's calculate the enterprise value using free cash flow to equity approach. The enterprise formula, as we already know, is summation of market value of equity and market value of debt. Let's calculate the market value of equity. Net operating income 100 minus interest, which is 10% of 100, which is 10, gives us the profit before tax of 90. Deducting tax, which is 18, we get a PAT, which is profit after tax of 72. Now, a company cannot grow without making investments. There is nothing like a free lunch. And hence, here comes another assumption, which is the net investments are 12. When I subtract the net investments from the profit after tax, I get the cash flow available to the equity holders, which is 60. In order to calculate the market value of equity, I'll have to divide this 60 by cost of equity minus the growth rate. And hence, the market value of equity comes to 400. We already know the market value of debt, which is 100, and hence the total enterprise value comes to 400 plus 100, which is 500. Now let's quickly look at free cash flow to the firm approach. Here, the formula is that the enterprise value is equal to cash flow available to the firm divided by the cost of capital minus the growth rate. No PAT is EBIT into 1 minus T, which is 80. And in order to calculate the cash flow to firm, I'll have to subtract the net investments, which are 12, from this 80 to get 68. Let's quickly calculate the WACC. The formula is already mentioned here. Please note that in free cash flow to firm approach, we provide tax shield in the denominator, which is in the WACC. You see that KD multiplied by 1 minus T, that is the tax shield that is being provided. This gives us a WACC of 17.6%. Calculating EV here gives us a value of 539.68. Now a big surprise that the EV from FCFE method is not matching with the EV from FCF method. The EV that we got from FCFE method was 500 against 539.68, which we got from this method. Now what exactly went wrong? To understand this, we'll have to look at free cash flow approach once again. We here assumed that the cash flow available to the firm is 68, and this 68 is expected to grow at 5% per annum. Now, since this free cash flow can be written as a sum of cash flow to equity holders, cash flow to debt holders, less the interest tax shield, we are making three different assumptions here. Now we are assuming that the cash flow available for distribution to the equity shareholders will increase at 5%. The same is the case with the debt holders' income, and similarly the interest tax shields will also grow at 5%. Now what is the problem here? Let's see what is the cash flow available to the debt holders. What is the amount that the debt holders are getting every year? They are getting the interest income. And we have already assumed that the coupon rate is constant at 10%. So we are effectively assuming that the interest expense that the company will pay to the debt holders will increase by 5% every year. Now, given that the coupon rate is not changing, and in order to give them more money, there's only one option left. And that option is that the company has to borrow 5% from the debt holders more in order to give them more interest in the following year. However, nowhere we have made this assumption that the company has to borrow more in order to grow. Let's see where we are heading. Just for the sake of argument, let's assume that the company does not go for any additional borrowing. One can ask here a very valid question, that why should the company go for any additional borrowings at all when the internal accruals are enough for the extra investment needed to support the growth rate? Let's see the problem in this case. The equity related cash flows will grow by 5% every year, but the debt related cash flows will not grow. What will this lead to? The market value of equity will change and the market value of debt will not change. And hence, the debt equity ratio will not remain constant. And what happens when debt equity ratio does not remain constant? The cost of equity changes. And with the change in cost of equity, the cost of debt also changes. And hence, the cycle goes on and on. So, in case of a growth company, we'll have to make one big assumption, which is that the debt to equity ratio has to remain constant at all scenarios. And hence, for the equity to increase, we'll have to grow the debt as well, and we need to take additional debt of 5% every year. Once this thing is sorted, let's quickly look at a revised FCFE approach. So what is the free cash flow available to the equity holders now? The free cash flow available to the equity holders will be 65, which is 60 plus 5 is the extra cash that the company will get from the debt holders. This will increase the cash flow to equity to 65. Remaining formula is same, and hence we now get a true enterprise value of 533.33. Let's now look at free cash flow to the firm approach. In this case, the free cash flow to the firm remains same, which is 80 minus 12. Why is this? Because equity shareholders get more 5, however the debt holders get 5 less, and hence the numerator remains same, which is 68. The WACC here, the formula remains same, however the values differ, and hence the enterprise value now comes at 533.33. We simply calculated it using the same formula but with a different values this time. Let's quickly look at a third approach, which is the capital cash flow approach. Do remember that in the capital cash flow approach, we do not adjust for the tax shield in the cost of capital. Therefore, the WACC formula does not include KD into 1 minus T. Hence, the new WACC here in this case is 18.125%. What are the cash flows available to all the holders? It's 65, which is the cash flow available to the equity shareholders. 10 is the interest paid of this period, and 5 is the money that debt holders had to pay out of their own pockets in order to pay to the equity holders, which gives us a total cash flow of 70. The enterprise value using the formula, which is capital cash flow divided by WACC minus G, gives us the same value of 533.33. Hence, we can clearly see that all the three approaches give the same value. The most important thing to note here is that the debt to equity ratio should remain constant. Otherwise, it will become very difficult to value any company using all the three approaches and get the same answer. So please do keep this in mind while performing the enterprise value calculations. Thank you.